Lovely. Thank you, Gillian. Thank you to the organisers for this event, the second in the series, and an opportunity for the independent research sector to showcase its independence, its integrity, and the quality of the work that it does. So far, the presentations that we've had this morning have brought us a remarkable mixture of views. We're going to get down to the nitty-gritty now, what we do with it all. We've heard from the macroeconomists, and you're all reminded of Harry Truman's expression, "Oh, for a one-handed economist." I have every view under the sun now to try and deal with in my portfolio. I've heard from the asset allocators as well, and I must say that perhaps the most telling remark so far that we have to chew on in this session is, of course, that all of the world economic system is stupid, from no less an authority than Charles Dumas from Kafka. So we have those in background for us. At Rubini, we have a range of considerations also to bring to the party, from macro through fundamental, through policy work as well. We're currently doing an awful lot of prepping for the sound of helicopters taking off. So the world of extraordinary and unusual monetary policy manoeuvres is not yet over. How to make sense of that at the sector level on a global basis. We now are joined by 4 colleagues and friends from previous times as well. Each of them is going to make a 5-minute or so presentation to you about how they see and approach the task of sector allocation. They're going to try and leave us all with an impression of how to, or some ideas for generating alpha, and if not alpha, at least some beta, that might go some way to helping beat the world as we see it now with all of its uncertainties. So today we're joined by Simon Goodfellow, the managing partner of Harlem Research, Tim Parker, chief executive at Messels, Charles Gabriel, Chuck Gabriel as I'm allowed to call him, president of Capital Alpha Partners, and finally Eric Liu, director and head of research at Vanda. They're going to present in the order that I've just listed them, so without further ado, let me hand over to Simon Goodfellow, managing partner at Harlem Research.
Good morning, everybody. Thank you, Andy. Thank you all for your attention. Please let me leave alive if I say something you disagree with violently. At Harlem, we specialise in probability-based investment. I don't have time to take you through the methodology, which is in any case quite boring. But what it does give us is a set of recommended allocations, both at sector and asset allocation, and indeed at country level, which we can repeat and test on a weekly basis. The great thing about probabilities is they're actually very easy to handle. The maths is easy, it's very intuitive when you're explaining it to people, and it is completely data-driven, which means that when we have something which doesn't look as good as we think it ought to, we have learnt over the years to take the problem seriously and go and look for a reason why such and such an asset or country is underperforming, rather than just saying it doesn't accord with our data. What you see in front of you is our sector weighting relative to benchmark for pan-European equities. This is based on the MSCI. The eagle-eyed amongst you will see that there is a small cap sector in there as well, so it's actually GICS level 1 sectors plus small caps. And what I want to sort of do today is, rather than going through all the sort of 11 recommendations, I'm going to leave you with 2 big ideas. But I do just want to sort of show you what the output looks like sort of up front over the last 26 weeks. Item number 1, consumer staples, still at the top of the list. We think it's really important, this. If I looked at the US, the equivalent chart for the US, you'd actually see telecom and utilities and consumer staples as the top 3. we do not see a rotation out of defensives. On our risk-adjusted work, we see these three sectors in the US holding up well, but consumer staples can do duty for that theme in Europe. The other thing that we see is particularly financials right at the bottom. It's not one of the really big ideas, because I think it's quite a commonplace understanding that there is some sort of problem with the profit model of banks. I think the interesting thing is that we picked it up very, very clearly. It's the orange line on your chart. We picked it up really very clearly as soon as it was understood that Fed rate rises might not be quite as fast as the market anticipated. But the big ideas are really contained in that crossover of health and energy that you see. The health is the sort of dirty pink line, and energy is the brown line. We think energy is on the verge of something quite interesting by way of recovery, and we think healthcare is showing signs of being in a crisis. So let me give you the long-run charts here. The last slide focused on the last 26 weeks. This gives you the history of our recommended weighting relative to benchmark in Europe over the last 20 years. And the black line you see meandering through it is the 52-week moving average. We've had quite an important point, literally in the last month or so. We've crossed up through this 52-week moving average. Well, the way we would interpret that is that the market has become aware of, or can now handle, extremely low oil prices, and is capable of working out who survives and who doesn't. And then when you suddenly find that you're in an environment where $25 or thereabouts is the bottom on WTI, and we might actually be dealing with upside, and it doesn't really matter whether the upside is $40 or $60. The point is we've seen the bottom, and we can price for upside rather than having to price for any significant amount of downside. This to us looks like a really, really decisive move, and it's one that we would want to follow. And secondly, healthcare. This is a sick chart. It's almost fresh air below where we are now. For some time we've been searching for an explanation as to why this is, and then we sort of went through Donald Trump's program for healthcare in the US. If you thought Hillary Clinton was left-wing, you should read his policy prescriptions. And one other really interesting bit of data that was in the FT yesterday, there's a report published by one of the pharma specialists, the wholesalers, which suggests that US prescription drug prices have doubled in the last 5 years. I'll tell you one thing for free now, they're not going to double over the next 5 years. And rather than forecasting static prices, you might at least wish to consider the idea that US healthcare prices, or the prescription drug prices, will go down significantly over the next 5 years. So price that risk, even if you decide that it'll never actually happen. So two ideas. One, energy now firmly in recovery mode. It's time to go bottom fishing. And secondly, US healthcare. Be very, very careful about political fallout.
Great, thank you. There we go. It is on. Thank you, Simon. Tim.
Good morning. My name is Tim Parker from Messels. We are a small, independent, technical provider. Technical research is our game. What I thought I'd do in my allotted 5 minutes is just rather straightforwardly remind you of why technical analysis might be important to you as the investor, and then just round up on what we think is an interesting sector at the moment. I won't tell you what it is just yet. But firstly, on the theory of technical analysis, the room is full of experts, I can see, and people who know much more than I do about this game. But I would like to point out that 25 years of doing this has resulted in reasonable alpha generation over time. And I just wanted to remind you of the theory. The first is, in price action or financial markets, do trends exist? And the answer to that is probably not, which is unexpected, maybe an unexpected answer. And what I mean by that is that in looking ahead, in terms of prediction, extrapolation, and everything else, you and I both know that the world, the future, is completely unknown. And trends that we see are all historical data points. They're patterns of a historical nature. And if you have a trend in play, or you think you have a trend in play now, well, actually you may not, because if you take two data points in the moment of now, they are exactly the same, so a trend is not underway, if that makes any philosophical sense. So what I'm saying is that trends are a historical collection of price data points, and patterns can be recognized. I think the universe is full of patterns, but can you extrapolate them into the future? Of course you can't. But what you can do is you can model them, and you can get through processes like serial correlation, autocovariance, a mathematical interpretation of what those price points certainly mean in the past, and therefore some sort of probability game going forward, but on the proviso that everything is unknown into the future. So we know about historical patterns, and it's self-evident to ask the question, well, do trends exist? Do bull and bear markets exist? Well, the S&P from 1980 through to 2000 was a clear bull trend, and that appears to be a bull market and a trend. Secondly, the gold price, in terms of the bear trend, from 1980 through to the brown bottom, I love that expression, the brown bottom in 1999 was a bear market from $850 down to $253. So in historical terms, these patterns do exist, and everybody knows that. What we also know is that human beings don't change. The investor behavior makeup doesn't change over time. Caveat genome sequencing in the future, but certainly as far as we know, investor behavior is to some extent unchanged, and therefore perhaps if you model it well enough, predictable. So that leads us really on to the question, if human behavior is predictable, how do you model it? And we're very simple in our lives. We apply Dow theory. Charles Dow was around at the end of the 19th century, as you know, first editor of the Wall Street Journal. And in a series of articles, he outlined a relatively straightforward trend following method. And you'll be aware of that, the 6 tenets of it, including the discounting of news and the 3 phases of price action and so on. I'm not going to bore you with that, but it is a very straightforward trend following system. But what's interesting about it is that it's not going to work 100% of the time, and you need trading rules to go with it, which you as an investor will have, your stop losses, your use of leverage, whatever the rules may be. And in Dow theory, the one big question mark that people always ask is, what about the trend change? So if you've got to a bottom in, let's say, oil, which was mentioned, and there's a reversal in the oil price, is this the beginning of a longer-term uptrend, or actually is it just a correction or a retracement in the longer-term downtrend? And that's a conundrum, and you have to scratch your head and say, well, hell's teeth, what do the rules say? The rules say, well, look at the base formation, and then you're left with the analyst saying, well, actually, it's the quality of me as the analyst looking at this data, coming up with my subjective interpretation of what I see. So that's really interesting, and I've done a big paper on this, the difference between the objective and the subjective response to what you see. And in Messel's, my colleague Dominic Hawker is fairly psychotic, and he's a very, very good observer of price action and very disciplined in his approach, and is then able to, with his subjective application, which is 40% perhaps of the process, on the 60% objective data, produce some good results. Okay, we live in a noisy world, as we know, and what we concentrate on is relative trends. So we go from one derivative away from price action itself. Price action, after all, is what the investor is actually doing. And you guys, whatever you may say about what you're doing, what you've done in your portfolios, and what you might like to happen, actually the price reflects what has been done. And the relative performance is just one derivative away from that, and can generate with some sort of return, certainly alpha return, in all market conditions. So even if markets are looking pretty horrible, there's always something that is outperforming, and that's what relative is all about, the balance between outperforming and underperforming. So a very noisy world. We're able to look at a huge number of asset classes, instruments, stocks, bonds, commodities, currencies, and come up with some sort of opinion. So just to give you one idea, this will show you how simple it all is. The theme for us really is that we're not tempted on a global basis to buy the banks. And the evidence, I'll just run through it. The top half of that chart shows the Bloomberg Bank Sector Index, and you can see in absolute price terms over 9 months or so, it has rallied back up the downtrend. Very simple stuff, and there's also a sideways level there. And the relative performance relative to the world index, again, has also rallied up to the downtrend. So that looks a bit as though we've had a rally, which has been pointed out earlier, but is it sustainable? In our view, not. And further reasoning, there's the S&P, this is the US banks, have lost relative momentum, turned to underperformance over the last 6 months or so, and done some considerable technical damage. That's a completed top formation. So US banks, S&P 500 banks, not in great shape. They could well rally, but up to previous lows and previous resistance. This is the European Bank Sector Index, shorter term chart, this one. And again, the absolute price has rallied to some short term, 33-month resistance, but the resistance is there, and the relative also has a bit of a problem. If you look at the Tokyo banking, so this is the Topics Bank Index, again, lots of overhead resistance, and heavy longer term relative resistance also to have to cope with. And then if we drill down to the stock level, just some quick examples. You can see that. If you can see them, the first one is Wells Fargo, top left, top right BNP Paribas, bottom left HSBC, new relative low recently, and bottom right is Mitsui Sumitomo in Japan. Again, all labouring under downtrends or relative performance, which is very indifferent. So darn simple stuff, but we're looking at this, we're flicking through charts like this on 400 or 500 a day, getting a sense of positioning, getting a sense, well, we'll come on to that, but getting a sense of relative performance. And the one idea today is don't be tempted by this bounce in the banks. Many thanks.
Great. Thank you very much indeed, Tim. And now we're going to hear from Chuck Gabriel, who's flying on fumes, having had a disturbed night on the flight over here, but nonetheless with insight from policy contacts and how it affects sector outlook for the US. Chuck.
Thank you. Good morning. So there we go. I am the president of a group called Capital Alpha Partners. I'm really grateful to be with you today. Kind of about an hour and a half sleep last night, as you might imagine, watching CNN from my hotel room over on Gottlieb Street. Actually was awakened by a fire alarm. And the last thing I think I heard was Ted Cruz trying to put a good face on a really bad night. So I'm grateful that my partner Courtney Oldham is here, because if I start speaking in tongues, she'll be able to translate for you. But our group is a little political forecasting group. I got my start at a little firm called Drexel Burnham Lambert in the early 80s. Our group is somewhat nomadic. We left Prudential in 2007 when they got out of the capital markets business, and we've gone independent. We have an arm's length relationship with Morgan Stanley, and we serve institutional investors. So, as you might imagine, every 2 years, frankly, we divide the world into red stocks and blue stocks. It's been somewhat of a very similar narrative now, all the way back to 2000, when we called them basically Bush stocks and core stocks. We've had a bit of an unrequited regulatory agenda from the Democrats for some time. And so, as you'll see, we have a somewhat lopsided list of industries and sectors that would benefit if you have a rightward shift. And yet there are some companies that, for instance, the healthcare sector, which has been talked about before me, has certainly transformed. It was a different story when the Affordable Care Act, Obamacare was coming, and it seemed such a massive threat a couple of years ago. Now it's basically established law, if you will, and there are many managed care companies, for instance, that are leveraged to the Affordable Care Act of Obamacare, so to speak, versus others like United Health that are less leveraged to it. So I'll get to this in a second. But you know, where are we? Obviously, we're in the 8th year of a presidential, two-term presidential cycle. Typically, on the 4th year, it's the second best year in a cycle. The 8th year, not so good. You can go back and remember 1988. You can remember 2000. You can remember 2008. It's interesting. There are some very interesting differences this cycle, and you have to. It's very difficult for any candidate from any party to win 3 consecutive terms. So there's an uphill battle of sorts for Hillary Clinton. But on the other hand, there's some things that you might imagine that work well for her because she's somewhat transformational. She might be the first female candidate. As I can point out, the electoral map in Washington, or the United States, I should say, is kind of trending a bit more blue based on demographics. We have more minority. The minority vote is up to 28% of the overall vote. In some formerly red states like New Mexico, Colorado, Nevada, even Virginia are turning blue, if you will, and President Obama's had a successful template in 2008 and 2012 about how to win. And then, you know, there are other factors as well that make it a little bit different. And I think the most interesting one about this cycle that is no doubt, you know, not missed by world investors. By the way, we understand that the United States is only part of a global investment equation. We understand as we travel around Europe, you know, we're reminded it's about 7% of an average portfolio of many of our European clients. And we have obviously we have a recovery that's, you know, 6 or 7 years in the making, and we're transitioning from 6 or 7 years of near zero interest rate, NZERP, or non, you know, near zero interest rate policy. So there's much to suggest that perhaps there's more value in European stocks. We understand that. We understand that perhaps the most dissed of all have been the British stocks because of the fears of the Brexit. So, you know, we understand all that. But what's really interesting about our cycle this time, and one of the thoughts I want to leave you with, is that the way we have based our forecast is that, you know, the United States populace is really very angry on both the right and the left. The expectations have been very high on the left. It's kind of like what Barack Obama has done with the Arab Spring. The expectations are just huge, particularly among minority groups that are now worried about whether Black Lives Matter on the left. And on the political right, you know, white working class anger is unbelievable. So in a way, for Trump, anger is his brand, if you will. It's amazing to have a reality TV star, you know, and a former billionaire that has basically offended just about every single constituency that you can, besides white, working class, blue collar, Reagan Democrats, could go as far as he could. But the key issue for us in this election cycle has been which of the two-party tickets or establishments can fight off this anti-establishment wave in a least destructive way. And it looks as though, as we've been predicting, the Democrats and uniting around Hillary Clinton will be better able to do that. So, you know, our forecast is 55% odds of the Democratic retained White House, probably, obviously Hillary Clinton. She all but sewed up the election last night. And it's a somewhat binary decision since Republicans have a 54-46 Senate advantage. They have to defend 7 seats, that class of 2010, in largely bluish states. Hillary Clinton will bring along a fairly big vote in key states like Ohio, in New Hampshire, and Illinois, and Pennsylvania. That they'll also, it's a binary decision. Whoever wins the White House will also win the Senate. And these are my red stocks and blue stocks. Just to make a couple of quick comments based on what we heard this morning. We think it's a very binary decision of sorts for energy. You know, the president has more or less doubled down for legacy purposes on everything from offshore drilling to an anti-carbon emissions plan, pollution plan, clean power plan that's been held up by the Supreme Court for now, but is not dead. And whoever wins the White House and takes the Senate will resurrect that. We're talking about issues ranging from siting of electric utility facilities, to the renewable fuel standard, exports. It truly is an amazing issue. Now, I know there's a complexity to this because we have a global energy glut. So if you get a Republican administration in there that gets back to Saudi America and it's gung-ho fracking, that could be a mixed blessing. But nevertheless, energy stocks are the purest of our red stock groups that, once we get through this overhang, it's a very important election. Again, we think it's going to go blue the other direction. So it's, there will be problems for the energy sector, sort of a continued braking, pedal, a little bit of a brake on the pedal. For healthcare, I think we heard the description that they're perhaps nearing signs of crisis. Healthcare, it's a very much more mixed bag. Donald Trump's original plans were quite frightening. He was talking the equivalent of universal health care and talking about Medicare drug pricing to complement the Medicaid drug pricing we've had for years. He's since begun to back off that. But Hillary Clinton is advertising in the hinterlands about wanting to really hit Valiant type operations and drug pricing in particular. So it's a particular threat. The likelihood of, the likely final result we get is going to be a bit of a threat for drug pricing, and that's going to be sort of first up in the cycle when we get onto the next administration. We'll probably have a bit of a defense buildup after a bit of a cresting of the defense spending cycle. It would be stronger under Republicans, so a little bit less under Hillary Clinton and Democrats. But defense is very much in play. And then finally, financials. If Republicans were to win, you'd have a very sharp, probably pushback on the last mile mandates with regard to Dodd-Frank for instance, the G-SIBs, the global systemically important banks, the 8 largest banks. For the most part, the capital rules are in place, but there are a few things that we're following through on that are important for those large banks. It's important particularly for the insurers who are just now beginning to be targeted by the FSOC and the Fed as systemically important themselves. A Republican administration, if Trump were to win, if any Republican administration were to win, you'd have a breaking of that. That would be good for insurers. You also have a bit of a break on a new set of conflict of interest rules for broker-dealers that are about to merge in the next 2 weeks, the so-called fiduciary duty rules that really try to deal with conflicted advice for IRA accounts in the United States. It will impact broker-dealers, asset managers, and to some extent insurers. Republicans would push back on that. So anyway, these are the little mini stories. We've got every one of these is a fabulous policy story. We understand policy is only one part of the equation. Another thing on a macro basis we just point to, I'm grateful to Dr. Ed Yardeni, who's a very good friend of ours who we worked with at Prudential. We're aware in Washington that this recovery's long in the tooth since 2009. Dr. Ed's thesis is it's been built on climbing one wall of worry after another, creating panic attacks that once avoided, fuel the market. And Washington had a very big role, as you'll recall, when we were having the European debt crisis and worries in summer 2011. We were also having a face-off that led to a downgrade of the U.S. sovereign in August of 2011 and a 19.8% drop in U.S. equities. That was all based on the initial fight for Republicans trying to assert a austerity policy, if you will. And so we had a panic attack then. We had another panic attack into 2012, as you recall, when we were worried about the fiscal cliff. And so, if we were going to have another panic attack, frankly, I think what might qualify once we finish this melt up that's likely to end in the next couple of months after we've recovered from, not having gone over the cliff of a global recession early this year. When we get up to say 2,100 on the S&P and things begin to crest a bit, I think what could really cause problems is if we start to either have a brokered convention, which would be the first one for Republicans since 1952, that could be very violent, that's become very trending. to see violent protests at Trump rallies. It almost looked like, the old Hell's Angel attacks back in the 60s. The Give Me Shelter. That could absolutely contribute to a panic attack this summer that could come right on target to get everybody to take profits and gird for the uncertainty that typically does come in the 8th year of a new administration, because people are girding for change. So, we're mindful of panic attacks. Again, this is the Electoral College map, this is the Senate map, so I'll leave it at that, but I'm grateful to be with this group. Thank you.
Thank you, John. Thank you very much indeed. And finally, Eric.
Morning, my name is Eric Liu. I'm the head of research at Vanda. Vanda is a macroeconomic and equity strategy research house. We're based in Hong Kong and Singapore, and we specialize in what we call tactical market strategy. So the way that we typically explain this to people is, for any given change in price of an asset, it's a function of some fundamental catalyst, be it political, economic, corporate, and the way that markets react to that catalyst, which is a function of investor positioning, behavioral effects, what's baked into the price. So we spend most of our time focusing on the latter half, which is the reaction function. With that introduction out of the way, let me just quickly use the opportunity to speak about how we look at global sector allocation. The first chart, you can kind of get the spirit of it from the chart. We are, I suppose, we are not valuation guys, and so this is a pretty simple scatter plot. The Shiller P valuations for the S&P on the x-axis and forward returns on the y. You can see that over different window periods on forward returns, the correlation gets higher and higher and higher. And so the yellow dots are 1 year, the orange is 5 year, and the purple is 10. And the basic idea here is, if you are a long-term investor, if you have 5 to 10 year money, valuation makes a lot of sense, particularly on the Shiller P basis. For most of the clients that we speak to, price discovery needs to come much quicker, so 5 to 10 months, or in some cases recently 5 to 10 weeks. So we are much more short-term oriented in the way we think about sector allocation. So how do we think about sector allocation? There are kind of two tenets to our views. One is that macro drives the directionality of sector allocation, and two is that positioning drives the magnitude of these sector moves. This chart is the U.S. Treasury yield in green and a ratio of cyclical versus defensive equities in purple. And I can tell you the European index looks exactly the same. So what this basically tells you is that macro in the form of Treasury yields effectively drive sector, relative sector performance in cyclicals versus defensive indices. It's a relatively simple concept, and I'm sure one that most people here are aware of, but it's the clearest way, I think, to think about how sector rotations come about. So this slide is entitled "Macro is Dead, Long Live Macro." In the latter half here is very clear. Macro is clearly very important in the short term. This is the European index, which actually tracks U.S. Treasury yields even more closely. But what about the first half of the title, which is "Macro is Dead"? And the reason why we say that is because for most of the 2000s, U.S. Treasury yields were driven by a very macro data set, which in this case is the U.S. Economic Surprise Index, which I'm sure many people are familiar with. But a funny thing happened in 2012. All of a sudden, you saw a massive decoupling between economic data and Treasury yields, and therefore, by association, relative sector performance. Now, what happened in 2012? Well, a few things. There was Mario Draghi's famous pronouncement of anything it takes, the third and final installment of QE from the Fed, and then obviously the election of Abe in Japan and the start of Abenomics. So we've moved from a world where forecasting Treasury yields and therefore forecasting sector allocations was very hard, and we moved to one where it's virtually impossible to forecast the sort of individual decisions and personalities of central bankers. So needless to say, it's a really tough decision, and it's a really tough process. And we think that we are moving back into a macro-driven one as we get off the zero bound. because there's more predictability in policy. But we're not quite there yet. So we know that macro drives directionality, but that's not the only thing that we look at. We also look at positioning. And so positioning for us is what drives the magnitude of the moves, the magnitude of the rotations, and the unwinds. So why does positioning matter? This is fairly obvious, I think, to most here. But these two charts just show you frequency distributions when the S&P is at different levels of positioning. And so the orange lines up there show you when the S&P, investors are underweight the S&P, and the blue lines show you when investors are overweight. And the top chart suggests that when investors are mildly underweight, performance tends to be a little bit better than when they're mildly overweight, so 60 basis points or so on a 1 month basis. But the bottom chart kind of shows you where it's really interesting, is when you're at extreme levels of positioning. So in here we say extreme being 1 standard deviation above or below the average. The differential performance is much more vast. So when you're extremely underweight, when investors are extremely underweight the S&P, median 1 month forward returns are 3% versus 90 basis points in the other direction. So, you know, I think a lot gets missed when people talk about flows and positioning, stock positioning levels. But the point here is where there really matters on the extremes, and particularly when we're talking about short term. So given what the importance that we assign to positioning, where we stand right now, this is a positioning chart for Europe and the UK. And you can see the most favored sectors are real estate, consumer staples, and retail. And the least favored, not surprisingly, are financials and materials and energy. A similar chart for the US, which we can kind of talk about as well. So I guess sort of the conclusion really is, one, in the short term, macro is what drives sector allocations. Two, if you could only know one data point to determine the sector allocation, it would be the treasury yield. And then three, positioning really matters, particularly at extremes. And I'll end by saying that most of those positioning data points that you saw on those past two charts are all available on Bloomberg, or you can swing by our booth to get a presentation. Thank you.
That's great. Eric, thank you so much for that. And that concludes the set presentations from our panel. We're going to have a little discussion now about what we can draw out of this. I have a remarkable and unusual feeling of consensus around a long-short pair, energy and healthcare. So let me just start off there before you all run away and start putting trades on the back of that. And Eric might want to say that that's going to become a crowded trade. I don't know. Eric, where are the crowded trades at the moment?
At the moment, so you know, we saw it in Europe. There's a lot of defensive trades. In the U.S., it's virtually similar. The defensive sectors, staples, utilities are highly crowded. Biotech continues to be fairly crowded. And the least crowded, energy, unsurprisingly. But retail is also extremely under-owned, which I think is fairly interesting.
Okay. So, guys, on the rest of the panel, I mean, is this time different? We've got the sound of helicopters in the background. We have remarkable movements on in terms of highly correlated asset price movements generally around the world. The days of secular bull markets that we grew up in the 80s and the 90s seem to be the thing of history, unless you hear some of the comments that were made this morning about the US being on the next swing up of a secular bull market. Is it different this time? Simon?
Well, I fundamentally disagree with the idea that we're in a secular bull market in the US. I am very nervous about the profit cycle in the US. I listen to all my macroeconomic colleagues talking about the health of the US economy, which I broadly agree with, but when you actually look at the profit margin in the US, which peaks at 13.5%, which is an all-time high, and when you consider its lows, are typically around 6%. Let's be charitable, let's say it only gets down to 10% this time. You've still got 30% of profits, corporate profits in the US at some stage over the next sort of 2-3 years. I don't see anything in the PE multiple that will compensate for that. So I'm afraid it leaves me feeling really quite negative about US equities in general, and therefore really quite relaxed about my still very defensive stance on sector allocation.
Yes, I mean, from our point of view, a technical point of view, equities indices worldwide have not broken out. You could argue there are top formations in place all over the place, so we're not there yet on equities. Bond yields, the interesting short-term action going on there. US T-bond yields are basing out short-term, and same with UK gilts. And the UK gilt has actually found support at the lows quite effectively. But the long-term trends, as you well know, are 30 years old. They're nowhere near being challenged. And if you look at Japan, negative rates and there's big resistance at zero on the, I mean, can you imagine the concept of resistance at zero on the JGB 10-year yield? So I would say the longer-term trend is still in place for lower yields globally, and that's well, it implies all sorts of things. But that on currencies, I just make the point that the dollar has not broken out, not broken either way. It's been consolidating now on the dollar index sideways in a range for several 2 or 3 months. Looks like continuing in that mode. It will break one way or the other at some stage, but it is range bound. But the key issue on global currencies has to be the response of the Japanese yen to the easing that was announced there, and the response of the euro to the easing from Draghi recently, the euro strengthening into that. So from our point of view, that's a reflection of perhaps of central banks losing a bit of control, or certainly measures getting a little bit more desperate, a little bit more out of hand. We're not great experts on that, but the point is these currencies are moving in perverse ways, and they are largely range bound. So they're doing funny things, but not actually trending particularly effectively at the moment. Finally, commodities. On that, is the world changing? I think the interesting point there, and I think we might come on to this, but WTI oil, which everybody's obsessed, $20 is the long-term level. It's not 25, it's $20, and we haven't reached it. And there has been an effective rally too, a lot of bullishness surrounding the oil price short-term. So I think the jury is still out on oil, and we haven't actually hit the low. We could certainly retest the recent lows. So a little bit of anxiety there, and more about range trading for quite some time, in my view. And precious metals, copper, and so on, I can discuss as well. That a lot of these things still in downtrends, despite some short-term base completion, which is, in our view, not good enough just yet. So the world is still troubled. We've got a negative call on the banks, but resources, in our view, also long-term downtrends, which are not yet dealt with.
So, if I may just sort of add, an observation of my own here. I mean, when I speak with young analysts, I'm allowed to say that now because I have so many grey hairs, when I talk to young analysts in sort of mentoring capacity, and get them to have a look at markets, they universally express remarkable surprise that current levels in the UK market, European market, and until the last couple of years, the US market, were first reached at the end of the last century, and since then we've been sideways trading. The commentary around the US market that only broke out of that sideways channel a couple of years back, and I was interested, Chuck, in your comment when you were talking there about the possibility of another panic attack in the US coming up as soon as the summer or the convention periods. Do you want to elaborate just a little bit on that? And if that does materialize, how far you see the potential downdraft on the S&P?
I think Washington would only be a sub-part of what could emerge as another panic attack. They tend to emerge just when it comes time for a global correction or a US correction. We may be due for one by midsummer. Unlike the one in 2011, which was really a very big cyclical austerity wave that had to be vented, and you had this very, very sharp initial midterm election cycle gag reflex to the Obama administration's efforts to not waste, not let a crisis go to waste. So they not only wanted to rebuild the U.S. economy, but essentially wanted to do so while creating universal health care and re-regulating the banks in a way that would be more friendly to low-income consumers and moving towards to deal with climate change. We essentially have put lead weights on the U.S. economy and attenuated and diluted this recovery with the Obama agenda, which is, again, sort of the unrequited agenda that goes all the way back to the Al Gore years. So I don't think that, we're not going to have a big breakout this summer, obviously, but I think that you could have concerns about unrest in the U.S., literally, because there is so much anger, and that's a really big issue this summer. Beyond that, I don't see another austerity wave for the next administration, and frankly, I think that the next, if you're looking at something that could actually create a new leg for this 7-year bull market in the U.S., if you were to have a Republican administration, you might actually have corporate tax reform and you move towards the equivalent of another supply side response to extend this. That's exactly what Reagan would be doing at this point, and others. We had anger management as our launch piece on Merchant Risk series. Our second one was actually great versus whole. And whereas Donald Trump is talking about making America great again, Hillary Clinton is talking about making America whole again. And so we have been about redistribution and dealing with this unrequited agenda, progressive agenda, for 7 years. We'll probably continue that under Hillary Clinton. If by some chance we're wrong and we get a Trump administration, I think that you're going to probably see a big supply side response. You might have, little fuel on the fire for a year or so, or for a while, but then there could be a real day of reckoning after a very short period.
There's your 45% probability case. Eric, since we've got this thing going around the likelihood of possibilities, are we in a breakout? Are we in a secular bull market on equities? The yield curve looks like, or the 10-year yield starts to look like, on your measures, pushing back towards defenses.
That's right. I think you've clearly seen that in banks, and I think positioning array reflects that. I suppose the interesting point is, we believe, by the way, as well as everyone else, that we get a flattening, largely because as Japanese pension funds start buying, they will tend to buy the sort of 5 to 10 year part of the curve. We think if there's a sector out, the banks clearly do poorly because they are borrowing short and lending long. If there's a segment out there that borrows long and lends short, that's the U.S. consumer. And so historically, when you see a flattening of the yield curve, U.S. consumers tend to do fairly well because auto loans are cheaper, mortgage rates are cheaper. And it dovetails nicely with the U.S. retail sector, which continues to be incredibly underowned. So we think there are ways to play it, but it's not good for the overall market.
Thank you for that, guys. Let's open it up now in the final few minutes, 10 minutes or so, I think we've got. Now to questions from the audience. Anybody want to get the ball rolling with a question for any member of the panel, or the panel altogether? There's a question over here. If we can just hold on to the microphone, and if you wouldn't mind just letting us know who you are.
Hi, Z Toll here. I'm an equity income research analyst. I have a question for Tim, if I may. Where did you get your £20 oil price from?
Dollars.
Beg your pardon, dollars.
Drawing a line. Historical price action. If you look at the chart, our big levels are 20 and 40. 20 and 40. So, whether they're right or they're wrong, they do emanate from previous price action many years ago, back to 1985.
I understood, if you go back to the end of the Second World War, the long-term real, adjusted for inflation, price of oil averaged about $40.
Well, if you're going to inflation adjusted, it does change the whole thing. And you could argue on the inflation adjusted chart, there's quite a nice little base breakout. But I think we're simplistic, well, you know, we're fairly straightforward in our analysis, and we're trying not to overlay different analyses on the price action, full stop. Can I just make the point that price action is quite perverse when it comes, or rather, the price action not perverse, the investor is quite perverse in their response to price action. So in oil, for example, you would suspect that a decrease in price would lead, an increase in price would lead to an increase in supply. And I'm drifting a little bit off the subject, but an increase in price would increase the supply of the hard asset or oil or the commodity or whatever it is. In financial markets, that is true, the supply-demand equation is true to a certain extent, but then the investor steps in and the prices start rising, so he buys rising prices. Does that make sense? So you're negating the negative feedback loop. So you've got this, so effectively what I'm saying is that the levels themselves are really, really, really important, because that's what the investor did last time, and either he was right or he was wrong. If he was wrong, he will want to redeem himself. If he was right, he wants to do it again. And we haven't got to $20 yet. So I'm not saying we get there next week or 5 years down the line, but with 20 to 50 as the big levels, and a lot of price action historically around there, I wouldn't be surprised to see oil around here for really quite a long time, sideways action, and a lot of euphoria coming to the market, which will then dissipate, and a lot of despair coming back in, which will also dissipate, but the price action will go sideways for really quite some time.
Can I just come in as the energy bull here? What I do want to say is that whatever happens, we're not going to get away without retesting the lows. So please don't go away with the idea that I think it's $40 and up from here. We have to test 20, 25, 27, whatever you think the level is. And that test probably happens in the second quarter. But I do think that we are beginning to have a list of companies who will survive, and indeed subsectors that will survive, and that can be priced on 2017 or even 2018 earnings, which will be substantially higher than 2015 earnings. And that, I think, is the discounting mechanism at work.
Yeah, the problem from a technical point of view is that when you're talking about $20 and $40, percentage terms, these are massive, massive moves. So on the long-term chart, it looks, you know, relatively minor. On an arithmetic chart, it all looks relatively minor. But you have to make it logarithmic, or at least acknowledge that 20 to 40, you know, that's 100%. So that's the problem, is that this bullishness and bearishness is now going to be always going to be exaggerated by the effective absolute price moves.
Okay. Time for a second question. Anybody want to put their hand up? Everyone's got their long, short pair. Always there one. So I beg your pardon. Yes, up on the back there. Thank you.
Very interesting to hear your thoughts about what will happen, but usually it says that no one can really read the future. So my question to you is, do you believe in the future of passive investment? And how would that fit in the current financial crisis and the consequences of having an active management?
I'm sorry, there was a problem hearing that. Was that a question about passive investment?
Yes.
Versus active, presuming?
Yes,
yeah,
in the future of the current financial system.
Let me try and interpret that more precisely. I mean, guys, is it the period now for a passive investment strategy?
No. And the reason I say that is that passive has become really, really popular, so it can't be right. Secondly, from a price action point of view, when you look at the dispersion of performance, and I talked about relative performance earlier on, what you're seeing is that some of these sectors are not really sending out huge outperforming, underperforming signals at the index level, the sector index level, but at the stock level, some stocks just go on churning it out in terms of persistent trends and outperformance, and some absolutely crater within the same sector. So if you're an active manager and you spot the earnings growth or the ROE or whatever you're looking at, sales growth, who knows what it is, and you have your model and you're picking the right stocks, you're doing well. And there are managers doing that, irrespective of sector rotation, irrespective of market direction. And the passive manager is getting absolutely, or the passive investor, sorry, not the manager, he's very happy. The passive investor is getting mullered. Can you imagine if you bought the FTSE 100 index, you got Glencore at £4.50 or whatever it was, you bought that at £4.50 and then you've got none of the upside, you've got all the downside. And that can be repeated in any number of names. So I would say that this is an era for the active investor who is under a lot of pressure from a cost point of view and publicity point of view actually to make his mark.
Thank you. Chuck, any insight from the policy world?
Yeah, unfortunately, the U.S. is obviously on a path right now with these new conflict of interest rules for broker-dealers and their registered reps and insurance agents, etc., who sell product into self-directed IRAs. We're expanding the fiduciary duty standard and duty to care, if you will, from just 401k and plan sponsors in the past now to IRAs. And essentially what this does, it starts with broker-dealers. It makes them have to really to blend commission rates at the individual broker or insurance agent level. And it's going to very much reduce risk-taking, because you can't have differential compensation for selling a stock fund versus a bond fund, if you will. That's called self-dealing in the ERISA world, as we call it. So it really is very much a threat. The clearest way, purest safe harbor for a lot of asset management for firms that are at the broker-dealer level is just to move to exchange-traded funds and to passive accounts, and move to fee-based accounts. And there's been a tremendous hue and cry that low-income savers, small savers, are going to be the most hurt because they're just not going to be efficient. But it's going to have tremendous displacement. These rules are coming out probably next Friday, the 25th. Probably right after the market close on Friday, March 25th. And the industry is going to have to adjust to this. It's going to be quite something, and it's something that's been out there coming since last April. It's very wheelhouse for the most part. It's within the typical firm in the U.S. There are those that have seen it coming. Really, are those who cover the asset managers, the insurers, or the broker dealers. But believe me, when these rules come out next week and we read the Wall Street Journal stories the following Monday, I think that the clear message is that this is really a body blow of sorts to active management, and it's very difficult for our industry.
So our challenging times just got a little more challenging, or will do. Let me assure the audience that no material non-public information has ever been passed in this room to the best of our knowledge. But we do leave you, as we wrap up this session, with a few thoughts from our panel as to core ideas. We've had the long short pair on energy and healthcare, the negatives on banks, and the watching out for positioning on crowded trades, and the role of the 10-year yield, and nice to see that making a return as the back end of the yield curve, sector rotation themes. So, ladies and gentlemen, thank you for your time. Gentlemen on the panel here, thank you for yours as well. And that's it from the sector panel.